The Minute's telling us the Fed is still very concerned about inflation and sees risks in cutting rates too quickly. So let's talk about what that could mean for the stock market with Bryant VanCronkhite, portfolio manager with Allspring Global Investments. Brian, welcome. Good to have you. You heard what Steve Leisman said, how he characterized the meeting, that the Fed folks are really more concerned with inflation risk than not. There was not a lot of clamor for a rate cut, which most people have been expecting. Jim Grant just saying, hey, don't take the possibility of a rate hike off the table. Where do you stand on all of this?
I remain steadfast in my view that the Fed's focus is on inflation first. Recessions are normal, and they're not afraid to trigger a recession if it means preventing runaway inflation. So I've been saying for a long time and repetitively that the market continues to try to get ahead of the Fed when the reality is the Fed's in no rush. I think the likelihood is that rates stay higher for much longer than what's being priced in, and the possibility of a hike is out there. Again, I think like Mr. Grant, that it's probably not likely, not my base case, but it's out there. And so as a result, as investors, we need to respect that. Respect the reality of a recession potentially being there, and how do we play the market accordingly?
So you're basically in the Grant camp, which was that rates will stay higher for longer. What does that mean for equity investors who have sort of counted, most of them, on the idea that rate cuts are coming sometime this year? Not March maybe, but maybe May, maybe June, maybe whenever.
Yeah, without a doubt, in the last 2 months of last year, the market started to embrace that early cycle playbook. Especially as you move down cap into the small and mid caps, we saw beta being embraced and what I'd consider low quality being embraced. The market priced that in essentially, so there was a little upside to that cutting dynamic. I think right now we need to be thinking about how to play defense in case bad things do happen, in case the wheels come off and the Fed loses control of the economy. How do we play defense? We're focused on balance sheet strength there. But let's not give up on offense, too. There's a lot of ways to create upside through companies deploying capital and controlling their own destiny. So today, I have a little balance sheet defense on the field, and I'm looking for upside through what companies can control on their own.
Let's talk about some of the opportunities you see in real estate, insurance, and healthcare services. CBRE Group, which is real estate, LabCorp, Arch Capital, among them.
I think CBRE is really interesting. Going back to what Mr. Grant said, right? You want to go where the market's anticipating trouble when you see something that's different. And what I see with real estate, and the public markets especially, is the market anticipates a lot of destruction. But CBRE is interesting. Not only do they have a grossly underlevered balance sheet with over $3 billion of capital available to spend on acquisitions, on buybacks, etc., they have a big part of their business which is service-based, so high recurring cash flow. The part the market cares about right now is the transaction-based activity, leasing and sales. If markets stabilize here, and even if they don't, you're going to see transactions pick up, and CBRE is gaining share throughout the last several years. I think CBRE is interesting in the fact the market's pricing it for trouble, when the reality is they have a lot of opportunity ahead of them, and they're going to win no matter what. It's just a matter of timing.
Let's give you one last thought on LabCorp.
LabCorp, again, looking to play offense when you have basically a defensive business model. Very low cost to get lab tests, but really critical to clinical decision making. That will be in demand in perpetuity for as long as I can be an investor. The opportunity today, though, is that they're consolidating their industry, and they're the best in the business at doing so. Look for them to use their balance sheet to acquire other labs, roll them in at very, very attractive multiples. The synergies there boost the margins. Over time, the market will price that in as cash flows and earnings power grows for the next 3 to 4 years.
Interesting thesis there on LabCorp. Brian, thank you very much. Bryant VanCronkhite. We appreciate it.